Okay. All right, great. Well, welcome everybody. Today is July 15th, 2022. So glad that all of you guys could join us today. I'm going to be discussing and introducing a new investment solution that we're rolling out. It's really a new take on an old investment solution. And that's the idea of using a structured note as a shorter term cash alternative. I'm going to be going through as many details as I can, as I think is appropriate for this call. I am sure there will be some additional detailed questions you will have about this cash structured note that I'm happy to discuss on a one-on-one basis, because it is a complex product. Many of you guys have already been invested in structured notes through us, going all the way back to 2018. For some of you, this will be your first introduction to this type of investment. And so I just want to let you know that I don't expect every single question you might have to be answered today on this video, and that I will be available in the coming week and a half or so to answer any specific questions you have about it, so that you can make the right decision about whether this investment is appropriate for you. Okay, so this call really came out of a question that I've been getting from so many of my clients right now, which is what to do with any cash that you have right now. It is a scary time in the market. You know, we're sitting on any given day, the market is down somewhere between 20 and 23%. It was up big today. And a lot of my clients are asking me, hey, is this the bottom? You know, we know we're supposed to buy low, but should we be buying right now? Should we be keeping cash right now? You know, what if we're scared, we're nervous that cash we put in the market right now drops in value? And so what tends to happen during these types of market cycles is, coming at the end of last year, nobody wanted to hold any cash at all because the market had been going up, 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 up. And so everyone was getting their cash into the market, essentially buying high. And then what our kind of lizard brains tell us to do is, as soon as the market drops, the fear kicks in and we go, oh, we need to hoard cash, hoard cash, hoard cash, when what we should be doing is buying low, right? Now is the time to buy low, not ideally when the market was high, but to buy low right now. But that's not always the best answer. And so what I want to do is go through what the appropriate uses of cash are generally, and then I'm hoping you can take this information, apply it to your own situation, or book an appointment with me to kind of talk through this on how it affects you individually. All right, so let me just throw out my best 4 options for cash right now, okay? First one is your boring old bank savings account, money market account, CD, okay? You're talking FDIC insurance, no fluctuation. It's going to be paying something less than 1% probably. You might find a really good deal out there on a CD, a short-term CD, or a special promotional savings account that might pay you a tick more than 1%, but you're probably looking at somewhere less than 1% on your bank savings money markets right now. Now, another option that a lot of my clients have been asking me about over the last 2 years are Series I bonds. Okay, these are kind of like your old savings bonds that you used to buy, your kids or your grandkids, from the bank, and you'd give them to them in $25 increments, and if you waited long enough, they'd become worth $50. Well, those were Series EE bonds. This is a different version of the same concept. Okay, this is a government bond issued only by Teasurydirect.gov. It's the only place you can buy them. Okay, I can't buy them for you. No broker can buy them for you. They have to be bought directly from the government. Now, what's amazing is the I in Series I bond stands for inflation indexed, okay? Meaning the rate that these bonds pay is a spread above inflation. Now, because inflation is so high right now, these bonds can be purchased through Teasurydirect.gov right now, paying between about 8 and 9%. Matter of fact, I think the most recent round of I bonds was paying like something like 9.2 or 9.6%. I mean, way up there. Okay, but here's the catch. You can only buy up to $10,000 through Teasurydirect.gov. You can buy another $5,000 using a tax refund on your tax return or by mail, which almost nobody's ever going to do. Okay, so in practicality, you can really buy $10,000 per year through Teasurydirect.gov. It's government guaranteed, and I'm going to get into a few more details in a little bit. Another use of your cash, okay, is this 12-month structured note. It's another option out there, okay? Compared to a savings account or a Series I bond, this thing is non-guaranteed, okay? There's nobody standing behind it other than the issuer of the structured note, which in this case is Citi Bank, okay? So you buying this structured note, you're subject to the credit strength of Citi Bank, okay? And it's going to be paying something less than 6%, somewhere between 0 and about 5.5%. Again, I'll get into more details in a second. I'm putting a $25,000 minimum on the purchase of this, but there's hypothetically no maximum. The other use of your cash would be to invest your cash in your long-term investment portfolio, right? This buy low concept, which is absolutely where the best return on your money is going to come from, as long as you have the time to weather out this market, okay? This either bear market or this recession market where, we don't quite know yet. All right, so what I want each of you guys to be doing in thinking about your cash is how to divide your cash wisely between the 3 uses of cash, okay? The first use of cash is your emergency fund. Everybody should always have an emergency fund, should be preserving their emergency fund through this period, right? The purpose of an emergency fund is it lets all your other strategies work. Without an emergency fund in place, as soon as things go a little off plan, your other strategies will break down. So we always maintain a good, robust, solid, safe emergency fund because it gives you the flexibility on the rest of your plan to allow that plan to work, all right? Other purpose of cash, funding short-term goals, okay? If you have a need for cash, and that need is going to come up in, 6 months, 12 months, 18 months, 2 years, okay? That has to be put in a that has to be segregated as short-term goal funds, okay? It's not appropriate for an emergency fund. It's not quite appropriate for long-term savings. It's something in the middle, okay? And we'll talk about the solutions for those short-term goals. And then the last one is your long-term savings, okay? Once you've filled up your emergency fund, once you've taken care of your short-term goals, now you should be using your cash to add to your long-term savings, all right? Those are the 3 uses of cash. And I want each and every one of you to fully understand how much cash you need for each of those 3 purposes. And if you don't have a good idea, that's when you need to schedule an appointment with me and we need to talk through it. Okay, so let's talk about that middle one, the funding the short-term goals. That's what I want you guys to consider, either the Series I bond for funding those short-term goals or this 12-month structured note, okay? The 12-month structured note and the Series I bond is not for emergency fund money, and it's not for long-term goals, okay? It's good for short-term goals, something that you might need this cash for in the next 12 months to maybe 24 months, maybe even 36 months, but usually a year or 2 years out, all right? So the Series I bond, again, let's do a little compare and contrast, all right? The Series I bond is probably your best bet, hands down, for like the first $10,000 of what you would need to fund short-term goals, okay? If you don't have any other short-term goals beyond $10,000, I would probably just go to Teasurydirect.gov and buy one of these $10,000 Series I bonds. You can't beat the rate, 9.62%. It is a variable rate, okay? So that is a consideration, but it's government guaranteed. You're gonna get your money back. You're gonna get your interest, all right? Really, that $10,000 max is the biggest downside of these Series I bonds, all right? They're not that hard to redeem, especially if you're only buying the electronic version up to $10,000. Now, with these Series I bonds, you must hold them for at least 1 year. You cannot sell them before the 12 months is up, okay? So you have to hold it for a year. Beyond that, you can hold these things for actually up to 30 years, all right? The term on these Series I bonds is up to 30 years. You have to hold them for 1 year, and then you can sell them back to the government before the 30 years is up. All right, and that's how you get your interest, and that's how you get your cash back. You sell them back to the government. Now, if you sell them before 5 years, you're going to have to give up a few months worth of interest. It's kind of like cashing out a CD early, right? If you have a 5-year CD and you cash it out a little early, the bank is going to withhold like 3 months worth of interest. It's kind of the same thing with these Series I bonds, okay? So if you cash it out before 5 years is up, you're going to have to give up a few months worth of interest. At 9.6%, I still think it's a smoking deal, okay? Now, if you have short-term goals, short-term funding that you need in excess of that $10,000, that's when you might consider this 12-month structured note, all right? Now, big compare contrast. There is absolutely no guarantee, no FDIC insurance on this structured note. The only entity backing up this note is Citi Bank, okay? So you are subject to the credit worthiness of Citi Bank, right? If they go bankrupt, your principal is at risk. If they go bankrupt, you will not get the interest, or you probably won't get any interest on this investment, and you'll be fighting to recover your principal, all right? So that's the subject to the credit worthiness, subject to the solvency of Citibank, okay? Hugely important point. This is true of every structured note, all right? The return on this 12-month structured note will be whatever the return is on the S&P 500 over the next 12 months, capped at 5.5%. We're gonna go into more details on that in a second. Okay, as I said, we're enforcing a $25,000 minimum for this investment with no hypothetical maximum, though I'll be uncomfortable if anybody's doing too much into this because of the credit risk aspect of it. Okay, so let's talk through a simple example of how this 12-month structured note would work. All right, let's say in a week and a half, you put $100,000 into this 12-month structured note. Over the next 12 months, the S&P 500 increases by 4.5%, measuring the starting point value of the S&P 500 and the ending point value of the S&P 500. It does not matter what happens in between. It only matters what the starting value is on July 26, 2022, and the ending value is on July 26, 2023, okay? You take the start point, you take the end point, you measure the difference. Let's say the S&P 500 increases 4.5%. You're going to get $104,500 back on your investment, a 4.5% return, right? Super simple, all right? Now let's look at a couple other examples, an up example and a down example. Let's say that instead of a positive return measuring the starting point of the S&P 500 and the ending point, let's say the S&P 500 drops 4.5%. In that case, you will put $100,000 in on July 26, 2022, and you'll get exactly $100,000 back on July 26, 2023. You will have realized a 0% return because the S&P 500 was negative over that 12-month period. Another example, let's say it's a good year. and the S&P 500 increases 10%, okay, your return is going to hit the cap, which is right now we think it's going to come in at about 5.5%. Okay, so it's going to be something less than 6% is the cap. Okay, so you're going to hit that cap. Okay, and you're only going to get the cap return back on your money. You're not going to get the 10%. You're going to put in 100,000, and you're going to get the capped return of 105,500. Okay, so this is a way to earn a little bit more interest on your money with principal protection, subject to the credit worthiness of Citibank, right? Compared to like your savings account, your money market account, which is paying something less than 1%. Okay, let's go over it. So again, there's a whole lot of details with these structured notes. I'm not trying to give you every single detail, but I am trying to give you the most important points. And I expect that if you are interested in doing this, you're going to reach out to me and we can talk through it in more detail. But here are some of the more key points that you need to know about this 12-month structured note. First one, I'll say it again. If Citibank goes bankrupt, your principal is at risk, okay? You cannot cash out this 12-month structured note before the 12 months is up, okay? It is locked up. And at the end of 12 months, there's no option to continue it. It just becomes cash. And at that point in time, you'll have to decide what to do with the cash. All right. This is a positive. Your return, your increase, your gain on that investment will actually be taxed at long-term capital gains rates, which is really great because usually products like this are paying interest that is taxed at ordinary income rates, but this is taxed at the more advantageous long-term capital gains rates. So that's a really good thing for all of my clients. We will not be charging any management fee on money invested in this 12-month structured note, okay? We're doing this as a complimentary service to our existing clients, all right? And this is simply looked at as a cash substitute, okay? This is not part of our long-term portfolio strategy. This is something we're doing on the side because we've heard from you that you do not want to be essentially losing money on money that you're keeping in cash and you'd like to do a little something else with it. So we wanted to make this available. So there's no management fee on any money you put into this, okay? However, you must add new money and it must be added to an existing account, okay? The reason we can't, it has to be added to an existing account is because I don't have the time to open up a whole bunch of new accounts for clients that want to do this structured note in a brand new account. So it has to go into an account that you already have with us that you can move new money into and we can buy this structured note for you, okay? This is a really key point, okay? The structured note on your monthly statement will show a loss. Okay, it will show being worth less than what you put into it. The reason is because this structured note actually trades kind of like a bond. All right, and when they price the market value of the structured note, the market value is always less than what you started with. All right, so when you put $100,000 in on your very first monthly statement, it's gonna show a drop in value. I don't know how much. I think it'll be something in the 2, 3, 4, 5% range, but it will show a loss, okay? However, when you hold it to maturity, you will get your principal back, okay? Subject to the creditworthiness of Citibank, all right? So you're gonna put 100,000 in, it's gonna show a loss for like 11 months and 29 days. And then when you get to maturity, it'll be worth what you started with plus whatever interest you've earned because of the contract agreement, okay? Okay, so what I wanna do, right? If you don't already have a good understanding of how to use the cash that you're sitting on, okay? This is the conversation I wanna have with you. How much of your cash needs to stay in short-term protected emergency fund, okay? And for that piece, we wanna be using savings accounts, money market accounts, and maybe some short-term CDs. How much of your money should be dedicated to short-term goals? That cash should be going into Series I bonds or the 12-month structured note. and how much of your cash is in excess of what you need for your emergency fund and your short-term goals. That excess cash should be invested in your long-term savings, okay, which is probably your Village Wealth investment portfolio. All right. You guys all know the fundamentals of investing, right? You know, buy low, sell high. We are undeniably at a low point. What we don't know for sure is whether this is the bottom, okay? But I can tell you that buying low right now will give you about an extra 15 to 20% return on your money, okay? You will get that by buying right now. However, it might take 2 to 3 years to get that extra 15 to 20% return on that long-term portfolio investment, okay? Now this is what I mean. All right, this is a review of some past bear markets, okay, past declines in the market that we've gone through. And what I did, well, I didn't actually do this. I took this from actually Capital Group, who had done this analysis. So when the S&P 500 has dropped by 5% or more, okay, that happens about 3 times per year. That happens all the time. And typically it takes about 43 days for the market to fully recover, right? We've been talking about market recoveries in past calls. How long does it take to get back to that previous high? Okay, so when the market's dropped 5%, it takes about 43 days to get back to a previous high. No big deal. When the market drops 10%, it takes about a third of a year, okay, 112 days, all right, 3 to 4 months to get back to a previous high. When the market drops 15% or more, now you're looking at more like 3/4 of a year, something like 9 months to get back to a previous high. And when the market drops 20% or more, which is where we're at right now, okay, you're looking at over a year to get back to previous high on average. Okay, now averages can be deceiving, right? We don't know whether this is an average decline or a non-average decline. Okay, so instead of this, okay, I've been kind of giving you guys a range, right? When you guys have seen this slide before. So when we talk about buying now in your long-term investments and trying to get that extra 15 to 20% return that you'll get by buying low, when we think about how long is it going to take to realize that, right now, you know, even though Capital Group and plenty of others who looked at previous bear markets are saying like 12 months, I'm really saying more like 12 to 24 months, all right? Because it's very well possible that we could end up going from a bear market where we're at right now to a recession. I still am a little bit on the optimistic side, and I'm not sure that we're going into a recession. But if we do, we are looking at possibly more like a 24-month, maybe even a 36-month period to hit a brand new all-time high in the market and get that get that 15 to 20% bonus return on your money by buying low right now in your long-term portfolio. All right. Okay, I'm going to go ahead and stop the presentation now, and I will open it up to questions. So again, what I want to reinforce is I don't expect you guys to all know everything there is to know about this structured note right now. But if you are interested, if you are not sure about what to do with your cash, please do reach out. Let's get an appointment scheduled in the next week or so, and let's talk through it a little bit and see if this is a solution that would be a good fit for you.